this, but I've not performed my obligation. It is a present liability to me. I have to provide a goods or service to the person. I'm here to do that. So because of that, I have a liability to perform. I have a present obligation to perform. So it is a liability to me. So that's why the key word is what? A liability is a present obligation of an entity arising from past event, the settlement of which is expected to result in an outflow, the settlement of which is expected to result in what? An outflow. An outflow, depending on the school that you are from. The settlement which is expected to result in what? An outflow of resources from the entity embodying economic what? Benefits. What does here? So, yes, if you are going to perform your obligation, that will result in an outflow, but the asset will bring in resource, so that will be inflow. So when you are defining liabilities and assets, which it can come, define assets because they know that you might be thinking of the basic knowledge and fundamentals and then the introduction to accounting. So asset is a resource that we use to produce goods and services. You have to define it according to the standard, according to what the principles, according to the IASB and the IFRS, right? So that is the liability. Rebecca Boabin, your hand is up. Please speak up.
Please, I have a question. So, according to the slide, there's been a revision of the definitions of the elements of the financial statement. So, are we supposed to give these definitions or the revised definitions?
What is the revised definition there?
Like those ones are the simplest version of these definitions.
Do you have it with you so that you read it to my hearing?
Yes, I have them with me. Should I read it?
Yes, please.
So, with a revised definition, an asset is a present economic resource. An asset is a present economic
Hey,
resource controlled by
idiot.
an entity as a result of past events.
Who is speaking? You can report who do level 400? Financial reporting from here.
Before 100. 400.
Financial reporting from here. Who doing 400? Yes, Rebecca, please continue.
So liability a liability is a present obligation of an entity to transfer an economic resource
No,
as a result of past events.
no. I mean the assets. Did you read the assets?
An asset is a present economic resource
Okay.
controlled by an entity as a result of past events. Should I continue?
That's all for the assets.
Yes, that's all for the assets.
Okay.
And a liability is a present obligation of an entity to transfer an economic resource as a result of past events.
Uh-huh.
An equity is the residual interest in the assets of an
Madam,
entity
they
after
do equity
deducting
here.
all its liabilities.
Madam. Yes, so basically it's the same thing, right? Why in short?
Yeah, but
And
the
then they've
simplest
introduced,
version.
sorry?
I mean, like they've made them simpler.
Simple, yes. But if you understand it, you even appreciate. But it's nice to say that it will lead to an inflow of economic resources. Because
Oh,
I don't know, you see, slides in Ankasa, they make things shallow. If it depends solely on the slides,
no, like the slide stated the old version. That's this one. This is the previous version. And the
I
one I'm
said
reading is the revised version.
revised version. Did they give any
Yeah.
standard for that? Did they give any
Yes,
standard
yes.
for that? What is the standard for that?
Unless I open my slides.
Oh, okay. So check the standard and tell me later. So basically, if you write this, you'll not be marked wrong. It's still correct, which will lead to an inflow of economic benefits. And so they've add present, right?
Yes.
To present economic resources. Present economic resources, right? Okay. And then
Yeah.
this one is, but the keywords are still there. Because if you take the keywords there, I'm sorry, past event, controlled, and then present obligation, past event, right?
Yeah.
So let's take it like that. All right. The equity. So equity is the residual interest in an entity after the value of all its liabilities are deducted from the value of all its assets. So the residual value that you get, right? That is the what? The equity. After you have deducted all your liabilities from your what? From your assets, whatever you get becomes your what? Liability. That's why accounting equation is saying that asset minus liability is equal to what? Equity, right? Asset minus liabilities is equal to what? Equity. So what is your the slide saying on the equity?
The equity. I'm coming. Um, Equity is the residual interest in the assets of an entity after deducting all its liabilities.
Mhm. That's all.
Yeah, that's all.
Okay, so basically the same thing. Okay. So now let's move on to the equity. Equity. We've done the equity. Income, sorry. Income. So income, increase in economic benefits during the accounting period in the form of inflows or enhancement of assets or decreases in liabilities that result in increase in equity. So when you hear income is what? Increase in economic benefit. Anything that will increase your benefit, your economic what? Benefit during accounting period in the form of what? Inflows or enhancement of an asset. Enhancement. It will whether you've enhance your asset, that is an income to you. So income is not just about you receiving cash, right? It's not about you receiving cash. But then when you improve upon your asset can now, you've increased the useful life of the asset. The asset was, it can operate for say 5 years or 7 years, but now you've increased it. Why adjustment? You've improved the asset. Now it can go to 11 years, 12 years. That is a benefit to you. Or a decrease in liability. Yes, when your liability decreases, it's an income to you. So add decrease, right? So decrease in liability is an income, right? That results in an increase in equity. Yes, if your income increase, your equity would also what? Increase, other than those relating to the contributions from equity participants. So the income is made up of the revenue, as I said. The income is made up of the revenue and then your gains, your revenue and your gains. Revenue is income arising in the course of the ordinary activities of the entity. It includes sales revenue, fee income, royalty income, rental income, and then an income from investment, interest, and then what? Dividend. And you can see that revenue is the income that you get in the ordinary course of what? Your operations. And that's why on the statement of profit or loss, another comprehensive income, or the statement of profit or loss, you see that the first item is what? The revenue. That is the revenue or the income that you get from your normal course of operation or in your normal operating activities, right? So that is the revenue. What are the gains? Gains mainly result from extraordinary activities. What is here? On the disposal of non-current assets. So the revenue is your normal business, your normal operations, the income that you get. But then the gains is your additional activity that you get, the gains that you get, or the income that you get in your additional activities, like disposal of a non-current asset. You purchase a non-current asset 10,000, it has depreciated by 2,000, you have 8,000. 8,000, you sold it for 9,000. 9,000 means you have gotten 1,000, right? Means you've gotten 1,000. That is a gain, right? It is not a revenue. It is a gain. So you get a difference between a gain and a revenue. They all fall under income. They all fall under what? They fall under income. Gains might be unrealized. Gains might be what? Unrealized. Unrealized gains occur whenever an asset is revalued upwards, but it's not disposed of. It's not what? Disposed of, right? You have realized that, like, you have revalued an asset which is supposed to be sold. Let's say the carrying amount of the asset is 5,000. This is the amount that you have in your books, right? Now, in the market now, they have revalued it. So the revalued amount is now, say, 7,000. So it means you are having some kind of gain, right? So if the asset has not yet been sold, so that's why he's saying that unrealized gains occur whenever an asset is revalued upwards, but it's not disposed of. That is unrealized. It is only when you dispose it of or you sell it that it becomes what? Realized. Do you understand? So it's only when you dispose it of that it becomes what? Realized. But when it's still in the company and you have not disposed it, then it is still what? Unrealized gains. Kimberly, your hand is up.
Sir, please, I want you to take that part again. The realized and unrealized.
Okay, so here we are saying that gains might be unrealized or realized. It becomes unrealized when you have not, it has been revalued outwards. So I said that the current amount is 5,000. Let's say the amount in the books is 5,000. And then it has been revalued. So revalued amount is what? 7,000. That is the amount that currently it is operating at, or the amount that you can sell it at the market currently, 7,000. Now, you can see that you are making some form of gain, right? You are making some form of gain. That is the 7,000 minus the 5,000, which will give you what? Which will give you what? 2,000, right?
1,000.
Yes, so the 2,000 is a gain. It becomes a realized gain when you actually dispose of the asset and you get the money. But then if you have not disposed of the asset and it's still in the books, revalued amount, blah, 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 then it is unrealized what? Gain. What do I say? Then it's still what? Unrealized gain. Do you get it now?
Yes, please.
Okay, so that is about that. Let's move on to the expenses. Decrease in economic benefit. The first one was income. Increase in economic benefit. The way I say then, decrease in what? Economic benefit. During an accounting period, blah, 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 in the form of outflow. But I'm going to say in the form of what? Inflow. That the no getting that opposite one is easy for you. Or depletion of assets in occurrence of liabilities. That results in decreases in equity. Expenses will decrease your equity. Accounting 1. Basic accounting. Expenses will decrease your equity. Incomes will increase your equity. What did I say? So that is the expenses. Let's move on to the next subtopic under the conceptual framework. Recognition and derecognition of the element of financial statement. How do we recognize this element? The element that we talked about. What are the elements? Yes, mention the elements. What are the elements of the financial statement? Quickly.
Yes.
Assets.
Assets,
Liabilities,
liabilities,
equity,
Equity.
equity,
income, and
Expenses.
income, and what? Expenses.
Expense.
So losses, are they expenses or they are income?
Expenses.
So expenses, yes. So they can ask, what are the elements? Do you know we have the component of the financial statement and the element? This thing confused some students. element of the financial statement and then the component. The component of the financial statement, one statement of financial position, statement of financial position, statement of what? Financial performance. So the profit and loss. The profit and loss, statement of financial, the profit and loss, and then other comprehensive, some of the other comprehensive income, level 300. You have other comprehensive what? Income. Other comprehensive. So other comprehensive income. What else? Then we have the statement of changes in equity, right? Statement of changes in equity. What else? Then we have statement of changes in equity. What
Cash
else?
flow. Statement
Statement
of
of
cash flow.
cash flow. Statement of cash flow. What else?
You have notes.
Note to the account. Note to the account. Note to the account, right? So these are the components, elements in the Mabubono. So now let's look at the recognition and derecognition of the element of the financial statements. So what are the recognition? So now recognition, the depiction of an element. How do you depict that this is an asset? This is a liability. This is an equity. This is an income. This is an expense. In words and by monetary words amount in the financial statement. So you see that we recognize all these elements that you have identified in the words in the financial statement, in words and then in monetary terms, right? Now, recognition of assets. So we are taking assets as the first item. How do we recognize an asset? Hey, this thing, they are the basic things. Every accountant must know this. Recognition of an asset. What are the recognition criteria? What are the recognition criteria? The measurement criteria. Recognition criteria, measurement what? Criteria. Hey, this is the recognition criteria. An asset will only be recognized till. An asset will only be what? Recognized if it gives right or other access to future economic benefit controlled by what? An entity as a result of what? Past events or transactions. Right? It gives rights or other access to future economic benefit controlled by an entity as a result of past event or what? Or transaction. Its cost can be measured with sufficient reliability. Its cost can be measured with sufficient what? Reliability. There is sufficient evidence of its existence. There is what? Sufficient evidence that the asset is existing. The asset is available. The cost can be measured with sufficient what? Reliability. The cost can be measured with sufficient what? Reliability. Right? So that is the what? Recognition what? Criteria. Hello, yeah. So these are the words, the criteria, the recognition words, criteria. So we say that it should be able to meet the definition of an asset. So that is the first one, meeting the definition of an asset, right? So it gives right or other access to future economic benefits controlled by an entity as a result of past transaction. So this point is meeting what? The definition criteria. So recognition of an asset, one, it should meet the definition criteria. And that is it giving rights or other access to future economic benefit
I did send
controlled
out
by
how I
what?
wanted it, but then
The
it
entity,
worked.
right? So this
I
first
don't
point is
know. I feel
meeting.
like he was missing something.
Hey,
What's it?
Ellie, you are always
Missing
feeling
something.
like
What's it? Pancake already like it doesn't feel like bread.
Shelly, you are
It
eating
feels
bread
like
while
soft
you
some
are, you
stuff.
are learning financial reporting. Hey, you are eating
Sorry,
bread
sorry.
while,
I didn't think I wasn't muted. Sorry.
okay. So the assets would be recognized if it meets the definition criteria. One, what is the definition criteria? Gives rights or access to future economic benefits controlled by the entity, blah, 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 blah. Two is what? The cost can be measured reliably. The cost can be measured reliably. Three, there is what? Sufficient evidence of the what? Of the assets, right? There is sufficient evidence of what? The assets. There is sufficient evidence of what? The assets, right? So if some can say that it is probable that future economic benefits would flow to the entity. It is probable that future economic benefits associated with the assets would flow in and out of the world of the entity, right? So for asset to flow to the entity, for liability to flow out of the world entity. What do I say? What do I say? So yes, this is the recognition criteria. Hey, hey, hey. This is the recognition criteria for asset or asset. So the standards that we have, the various standard, it has been grouped under assets, under liabilities, under performance standards. What do I say? All the standard that we have. We have the asset standards, we have the liability standards, and we have the performance standards. So all assets recognition criteria is that one, it should meet the definition criteria, which is it gives right or other access to future economic benefits controlled by an entity. Two, its cost can be measured with sufficient reliability. Three, there is sufficient evidence of its existence. Cost can be measured reliably. It is probable that future economic benefit associated with the item would flow to the entity. So this is the recognition criteria for assets. Recognition criteria for liability is a liability would be recognized when there is what? Obligation to transfer economic benefits as a result of past transaction or event. So this one is also meeting the definition criteria. So the key thing is that it should meet the definition criteria. So if you take the item and you want to
Sir, please come again for the liability.
for liability, yes, we said the liability is that, or the liability would be recognized if there is an obligation to transfer economic benefits. If there is an obligation to transfer what? Economic what? Benefits. So it should meet the definition criteria. All the items, all the elements, they should be able to meet the definition of criteria that they belong to. So asset, we are saying that it should be what? An economic resources controlled by the entity. Liability is also saying that there should be a present obligation, an obligation to transfer economic benefits as a result of what? Past transaction. So if you take a transaction, a particular transaction, and you're going to recognize it in your books, you're going to recognize it in your books. Read that transaction and ask yourself, is this particular transaction meeting the definition criteria of a liability? Is it meeting the definition criteria of a liability? Liability is a present obligation, which will lead to an outflow of economic resources. So if you take a particular transaction and you're going to recognize it, ask yourself, is it meeting the liability criteria? If it is meeting, then you recognize it. What does it? So the recognition criteria that you are going to follow. 2, it can be measured with sufficient reliability, and then it cut across. There is sufficient evidence of its existence. There is what? Sufficient evidence of its existence. And I say it is probable that the future economic benefit associated with the item would flow out of the what? Entity. It is probable that future economic benefit future economic benefits would flow out of the entity. What is it? So the first one, it is probable that future economic benefits would flow into the what? Entity. So there is evidence, the evidence of its existence. There's evidence that future economic benefit would flow into the entity when it is a liability. There is evidence that future economic benefit would flow out of the entity if it is a liability. Are we fine? Are we okay with the recognition criteria
Yes,
for
please.
assets and liabilities? Hello?
Sir,
Yes,
please
sir.
take the assets again.
Yes.
I should take the asset again.
Yes.
The asset is saying that assets would only be recognized if it meets the definition criteria of what an asset is. If it meets the definition criteria of what an asset is. So what is an asset? It's an economic resource that is owned and controlled by what? An entity as a result of what? Past event. So here, the first point is saying that it gives rights or other access to future economic benefits controlled by an entity as a result of what? Past event. Ownership nipo there, and we said that control control. The party controlling the asset would recognize it. The party or the entity who is controlling the asset at a period in time, who is the one that will recognize it in its books, is the one that will recognize it in its books, right? So we are saying that it should meet the definition criteria. Here it is meeting the definition criteria that is giving the rights to the future benefit, right? You have the rights to get the future benefit. The second one is that the cost can be measured reliably. You can measure the cost of the asset. How much is the cost of the asset? 20,000, 20,000. How much is the cost of the asset? 20,000. Okay, then we know the cost. Now it can be measured what? Reliably. We know the cost of the asset, 20,000. It can be measured reliably. The third point is saying that there is sufficient evidence of its existence. Yes, it is probable that future economic benefits associated with the item would flow into the entity. So it is evidence. There is sufficient evidence that the benefit, the future economic benefit, would flow into the entity. There is future evidence that benefit would flow into the entity. Benefit would flow into the what? Entity. Are you fine now?
Yes, yes.
All right, let's continue. So I believe you are fine with the liabilities as well. So recognition of income. Income is recognized in the words in the income statement, right? Income is recognized in the income statement. So an increase in future economic benefit arises from an increase in assets in an asset, right? Or a reduction in what? A liability. So we will only recognize an income if it increases what? Economic benefit. So basically it's following the definition of what? An income. Following the what? The definition of an income. So an increase in economic benefits arises from an increase in an asset or a decrease in what? Liability. A liability. The increase can be measured what? Reliably. It has increased by a brofo. Mo Nyankanduri. Nyankanduri senior high ni other senior highs no. And it can be measured what? Reliably. So an increase means increase by and then increase to what? 2, right? Increase by and then increase to. So you can measure the increment. Then you can see that you can recognize it. If they say that the income has increased by can you recognize it in your books? If they say income has increased by can you recognize it in your books? Can you recognize it?
No.
Why? Why can't you recognize it? Why can't you recognize it? Hello, why can't you recognize it?
Then maybe it has the value has not been physically added to the existing amount.
Cost cannot be measured reliably. Reliably. You cannot measure the cost. So how do you recognize it? What is it? So if
Okay.
before you can get the amount, if you get the amount, you can recognize it. If the cost cannot be measured, you cannot measure the cost. Then how do you recognize it? So with the income increase, the definition criteria and then the cost can be measured reliably, right? Expenses are recognized in the income statement. A decrease in economic benefit expenses, decrease in what? Economic benefit arises from
Yes.
decrease in what? Assets. And then decrease in what? Liability, right? Sorry, increase in liability. Increase in liability. That is an expense, increase in liability. And then can be measured what? Reliably. Can be measured what? Reliably. Can be measured reliably. Right. So, how do we derecognition? Derecognition is the removal of all or part of the
Yes.
recognized asset. Yes, sometimes you have recognized it, but then you can derecognize part of it. So that is you removing part of the assets in your books, maybe because of um say what example can I give? Maybe the asset has been sold, right? You have sold the asset. It was in your books initially. When you bought it, you recognize it in your books. Now you have sold the asset. What do? Should the asset still be in your books? No, you have to what? Dispose of the assets. You have to derecognize, derecognize academic writing 1, academic writing 2, derecognize, right? So derecognition normally occurs when that item no
We don't
longer
see this
meets.
word inside.
Sorry?
We didn't see this word inside though. Academic press.
You didn't see this word in academic writing?
Yes.
Who was your lecturer? He didn't teach you derecognition. Hey, you didn't see this derecognition in your academic writing. Hey, course no yeah when Lego no yeah course na so yeah what different school.
Lagos. Lagos. I'm not alone. We are plenty.
Hey, I didn't see the
So
recognition.
we didn't do vocabulary, so
Ah, but what did you do? Academic writing, you didn't do vocabularies. Really?
no, yes.
Which slide did your lecturer use?
He uses his head. Oh.
Hey, ah, I see. Ayo. Then go and research on it since your lecturer didn't teach you. So derecognition is the removal of what? So let's say you have disposed part of the asset, right? So you need to derecognize it from your books. You take it out of your books, right? Because it's no more in the business. So you need to take it out of your books. Derecognition normally occurs when that item no longer meets the definition of an asset or a liability, right? So for an asset, derecognition normally occurs when the entity loses control of all or part of the recognized asset. You have lost in control. That means it is not in your control, so you have to derecognize it, right? B, for a liability, derecognition normally occurs when entity no longer has a present obligation, has a present word obligation, right? Has a present obligation for all or part of the recognized liability. Good. Measurement of the element in the financial statement. How do we measure it? We've talked about the recognition. Measurement of the elements in the financial statement. Elements recognized in the financial statement are quantified in what? Monetary terms. So this requires the selection of a measurement basis. You are going to follow specific measurement basis, right? A measurement basis is an identified feature of an item being measured, right? Of an item being measured. So for assets, we say that it is initially measured at cost, at the historical cost. So we've talked about the recognition. That is the 3 points that I gave earlier for assets and liabilities. When we come to the measurement criteria, the measurement what? Criteria. So the measurement criteria, we said initial measurement is on what? First time measurement. So that's the initial measurement. First measurement is what? It's on cost, historical cost, the cost of the asset. The subsequent measurement is what? Can be on the cost or the revaluation. You can be on what? Cost or what? The revalued amount. What is it? So let's look at the historical cost here. Historical cost is saying that the historical cost of an asset when it is acquired or created, the value of the cost incurred in acquiring or creating the asset. The cost incurred in what? Acquiring or creating the what? The asset, plus any what? Transaction cost. So any cost that you incur in getting the asset, becomes your what? Your historical cost. So the historical cost of a liability when it is incurred or taken is the value of what? Consideration received. So then what's the historical cost of assets? That is the cost of what? Acquiring or creating the what? The assets. So the consideration that you paid, then consideration that you what? You paid to acquire the asset. For a liability, right? So that is the cost incurred or taken. That is the value of the consideration received to incur or take the liability minus what? The transaction. So the consideration that you receive. Here is consideration that you what? You paid. What I say? So that is the historical cost. We have the fair value. The fair value, also the measurement basis. Fair value. Fair value. So fair value is the price that would be received to sell an asset. The price that will be what? Received to sell an asset or paid to transfer a liability in an orderly transaction between marketable or market participants at the measurement date. Fair value is the amount that you would receive if you sell the asset today at the market. If you sell an asset at the market, what is the amount that you'll be receiving? That's the fair value. So that's the price that will be received to sell an asset or paid to transfer a liability. Oh, person, I want you to perform this liability, so I'm transferring the liability to you, right? So that the amount that you pay in transferring the liability to the third party is the fair value, right? Fair value reflects the perspective of market participants in the market to which the entity has what? Access. We have the value in use. Value in use provide information about the present value of the estimated cash flows from the use of an asset and from its ultimate disposal. So when you say value in use, it's the value that you get when you use the asset. For value in what? Value in what? In use. So the value you get when you are not selling the asset, but rather utilizing the asset. Utilization of the asset. What is the value what value do you get? So that is the word value in use. Value in what? Use. I've decided that I'll not sell the asset. Yeah, maybe I'll use the asset. If I use the asset, what is the value that I'll be getting? That will be the value in use, right? So that's you discounting the various cash flows, right? So that is the value of the estimated cash flows from the use of an asset, from its ultimate disposal, right? The information may have predictive value because it can be used in assessing prospects for future net cash flow, right? So here you discount all the estimated cash flows, you discount them into the present value, right? Do you remember those who read business maths, discounting factor, right? Do you remember that? Do you remember the discounting, annuity, and the rest, the single value?
Yes, please.
Yes. So you have to discount it into the present value. So when you are given certain cash flows and you are asked to calculate value in use, calculate the value in use, just discount all those values or all those cash flows given the discount factor or given the discount rate. So the discount rate that will be given to you, but discounting all the cash flows. So whether outflow, inflow, discount all of them. Then you get the value in use, right? Then you have the current cost. Current cost of an asset is the cost of an equivalent asset at the measurement date, comprising the consideration that will be paid at the measurement date plus the what? Transaction cost that would be incurred at that date. So the current cost of a liability, the consideration that would be received for an equivalent liability at the measurement date minus the transaction cost that would be incurred at that date, right? So at the measurement date, it's a say then current cost. Oh yeah, academic writing 1, writing 2. The current cost is what? Current cost. And we come to the concept of capital and capital maintenance. I think it wasn't part of the slides. It wasn't part, or even if it was in the slide, we didn't focus on it much. But then, since things are changing now during your era, let's look at it. Concept of capital and then capital maintenance. Concept of capital and then capital maintenance. Financial capital maintenance. so we have the financial and then the physical capital maintenance. Into brofuni then capital maintenance. So on capital, right? Accounting 205 and then 208. So you know capital maintenance. We have the financial capital maintenance and then what? And the physical capital maintenance. Under this concept, that is the financial capital maintenance, a profit is earned only if the financial or money amount of the net assets. So the money amount, right? Only if the what? The financial or the money amount of the net asset. The what? Net asset. Of the net asset at the end of the period exceeds the financial or money amount of the net asset at the beginning, the end and then the beginning, where the beginning is more than the end. Financial capital maintenance, under this concept, profit is earned. Profit. So profit is what? Profit is earned when the amount, that is the money amount, of the net asset at the end of the period, net asset at the end of the period exceeds until when the closing balance is more than the opening balance. So when the net assets at the end of the period exceeds the financial amount of the asset at the beginning of the period, beginning, someone will say beginning. So beginning of the words period, after excluding any distributions to and contributions from owners during the period, right? So financial capital maintenance can be measured in either nominal monetary unit or unit of constant purchasing power. So it can be measured using the nominal monetary unit or the constant purchasing power, right? So money financial capital maintenance does not take into account inflation. Inflation. What is an inflation? That is the persistent increase in the price, general price of goods and services, right? So the money financial capital maintenance does not include what? Inflation. It does uses historical cost measurement. It uses what? Historical cost measurement. Real financial capital maintenance, however, takes note of what? Inflation. And so uses current prices measurement. It's real or no? It uses what? The inflation. It uses inflation, so it considers the current prices what? Measurement. So here, note that that is when the closing amount, profit is earned when the closing amount exceeds what? The beginning amount, right? Basically, that is the financial capital maintenance. When the what? Profit is earned when the what? When the net amount or the net assets, the amount of the net asset at the end of the period exceeds the what? The beginning period, right? So that is that. Then we move to the physical capital maintenance. The physical capital maintenance. Physical capital maintenance, under this concept, profit is earned. So profit is earned only if the physical productive capacity, to hear the physical productive capacity. Here it is talking about the capacity, not the what, not the money, monetary aspect of it. So profit is earned only if the physical productive capacity or operating capacity of the entity or the resources or funds needed to achieve that capacity at the end of the period, when at the end of the period exceeds, what? The physical productive capacity at the beginning. So when the end is more than the beginning, when the end, profit is earned when the end of the physical productive capacity exceeds the what? The physical productive capacity at the beginning, right? So the physical productive capacity at the what? At the beginning of the period, right? After excluding any distributions to and contribution from owners during the period. What I say? afterwards, excluding any distribution to and contributions from owners during the what period. So basically, this is about what? The conceptual framework. This is about the conceptual framework, right? And the regulatory framework. Any question? Any question, please?
No, I was starting a bit.
Any
I'm not
question?
starting it, man.
Oh, yeah, no, person. So, what is the regulatory framework? If you have no question, let's move on to the quickly regulatory framework. The regulatory framework, it's like how the framework would be what regulated, how the conceptual framework is being regulated. So the IASB is a board regulate the what conceptual framework. We can talk of the IFRS and the national legislation like the Partnership Act, the Banking Act, the Insurance Act, the Financial Admin Act, and what have you. And also the IFRS committees are also responsible for that, for the regulation. So these are basic stuff. Let me see. So that is basically about, usually our focus, or the focus is on conceptual framework. The regulatory framework, you need to know which entities are involved in the regulation, which is the IASB, the International Accounting Standard Board, the IFRS. What is the meaning of the IFRS? What's the full meaning of the IFRS? IFRS. What is the full meaning?
Financial reporting standards.
Sorry?
National Financial Reporting Standards.
International Financial Reporting what? Standards. And USA uses what? The GAAP. USA. They uses what? The GAAP.
Financial reporting.
What's the full meaning of the GAAP?
Generally accepted accounting principles.
Wow. So that's what the USA, they would make a difference. UK na use IFRS ni blah 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 na Ghana. But then USA say, oh no, up a gap. What I say? So basically, that is all about conceptual framework, and that is the first topic under the course that we are to look at. And thank God, by God's grace, we've been able to deal with that. So we are done with the conceptual and regulatory framework. So you can read on the regulatory framework from your slides. You can read on that. But what you need to know is that the regulatory bodies that regulate the conceptual framework, which I've talked about already. So we'll be looking at the presentation of financial statements, and also the start with PPE, property, plant, and equipment. So these are basic stuff. These are the topics that we'll be looking at in our next meetings. Any question, please? Any question?
Sir, please, will you share this slide with us in the group?
Any question, please?
Sir, please, will you post the slides in the group?
Which slides? I'm not using any
The
slides.
one you shared. No, this one, the one you prepared.
It is not called slides.
Oh, okay.
Yes, it is
So
not
we can't
called
access
slides.
it.
Sorry?
So please, we can't access it.
You want to access it. It did not complete. It will be. It did not complete. So I don't want to share it, right? And moreover, that is a book. It is not a slide. It's a book. It's financial reporting book. So it needs not to go out, right? It is unshareable.
Okay.
You get it?
How much?
No.
Oh, how much the price number out here? Until we are done, almost done. We were supposed
So
to finish, but
can we
then
get a sample?
sorry,
Can we get a sample before the price
exam,
comes out? Yes. Like 2
example.
topics. Yeah, to be going through of the book before it comes out. Have you said the price is not out?
Yes, please.
Yeah, so something to keep us busy there. So
Oh, don't worry. I'll teach you,
okay.
and I'll give
No
you the relevant stuff, right?
wahala.
Yeah, but you said the class was being recorded, so that one the video also being